Welcome back to the deep dive. Today, we're opening the cabinet on one of the most, well, stable yet surprisingly complex companies out there, Colgate-Palmolive, tickers CL. This is a real giant of the consumer staples sector, that defensive corner of the market. And chances are you probably use one of their brands literally every single morning. Our sources today are really digging into the investment side of Colgate. And our mission really is to get our heads around this kind of paradox. How does a business that sells, the most essential stuff like a simple tube of toothpaste, how do they manage in this, well, volatile global economy? We're looking at their financial efficiency, which is pretty exceptional, but also weighing that against the unique and sometimes pretty dramatic risks that come with selling these everyday things.
It's a great case study, actually, because consumer staples, that whole sector, it's supposed to be the market's anchor, right? These are the thing, food, toiletries, household cleaners that people buy consistently. Doesn't really matter if the economy is up or down.
Yeah, you still need toothpaste.
Exactly. And back in 2022, when everything else felt shaky with inflation and uncertainty, this sector, well, it often held up really well. Kind of proved that defensive label.
And, it's funny, when you try to actually pin down how big this market is, the numbers go all over the place. We looked into different research reports for the global consumer staples market, and the 2024 estimates we found were like from maybe $33 billion all the way up to almost $220 billion.
Whoa, that's a huge range.
It's massive, and it seems to depend entirely on what the researchers decide to count, Like, do they include fresh food or unpackaged goods?
That huge difference just shows how tricky it is to draw the line around this market. But here's the key thing, the bit you really need to latch onto. Despite that whole debate about the total size, pretty much every analyst agrees on the growth rate. They're all projecting this very consistent compound annual growth rate, the CAGR, of around 4.2% to 4.3% over the next few years.
Okay, so slow and steady wins the race, kind of.
Pretty much. That predictable, steady, sort of low drama growth, that's the foundation for a company like Colgate. It doesn't really matter how big the whole pie is, their slice is expected to grow consistently.
Got it. So a massive steady market. But even steady markets have things pushing them forward, right? These big long-term trends. What are the main global tailwinds helping a multinational like Colgate right now?
Well, looking globally, there are really three big forces shaping things. First is just ongoing global population growth. Plus, you've got faster urbanization, especially in developing countries.
Mm.
As millions move to cities, how they shop just fundamentally changes. They want convenience, so they shift away from, traditional stuff towards modern, ready-to-use packaged goods. That alone creates huge new demand for everything Colgate sells.
Makes sense. And the second big one, which has completely changed how products get to people, is e-commerce.
Oh, absolutely. E-commerce isn't just convenient, it's like totally reshaped the landscape. It breaks down geographic walls. For Colgate, it means people in even really remote areas can now get their full range of products. They can bypass the old, sometimes clunky retail setups. It lets them reach new customers much faster, more directly.
And the third one, this is more about values, I guess, which helps them charge a bit more, maybe the whole sustainability trend.
Yeah, this is really important, especially for holding onto margins in developed markets. People are more and more willing to pay extra for stuff with eco-friendly packaging, ethical sourcing, natural ingredients. Brands that get this right, like launching a recyclable toothpaste tube or a natural deodorant, they tap into this profitable premium niche.
Mm.
It helps justify why their product costs more than the generic sitting next to it.
Okay, so those are the tailwinds.
Yeah.
But where's the pushback coming from? We found some evidence suggesting there's this kind of quiet but really intense battle happening on the supermarket shelves, the private label threat.
Ah, yes. This is the sector's big headache right now. And that period of high inflation, say 2022 to 2024, that really put brand loyalty to the test. Input costs went through the roof, so companies like Colgate had to push through some pretty significant price increases to protect their margins.
Right.
But every time they do that, they make the store brand, the private label, look that much more attractive to shoppers.
And the data shows people actually did switch, didn't they?
Yeah.
Especially in places where the store brand quality is pretty decent.
That's the scary part if you own the brand. Our sources suggest something like 40% of European consumers tried a private label brand during that high inflation time. And it wasn't just trying it once. There was a huge 31% brand switching rate, specifically in household and hygiene products. That's not just a temporary blip in sales. It's potentially a long-term hit to brand equity, chipping away at the trust Colgate spent decades building.
Wow, 31% switching. That's huge. So the challenge for management is like walking a tightrope. They need to keep prices up to protect those margins.
Yeah.
They fought hard to get back. We'll get to that later, but if they push too hard.
They risk losing customers for good to the cheaper option, losing market share, losing volume. It's a really tricky balance, all about price elasticity.
Yeah, they have to constantly prove why their brand is worth the extra money.
Exactly. They need to keep innovating, even on basic stuff, just to justify that price gap. If the generic is seen as good enough, the premium brand is definitely in trouble.
Okay, that perfectly sets up looking at where Colgate actually makes its money. Let's zoom in on their two main markets, starting with the absolute core, oral care. Huge market, essentials, estimated somewhere between, $33.6 billion and $47 billion globally.
Yeah, it's massive. And the growth drivers are evolving. It's not just about basic cleaning anymore, especially in developed countries. It's more about people understanding the link between good oral hygiene and overall health, things like heart disease, diabetes. Plus, you have rising dental problems globally, and then this constant stream of innovation in niches like whitening, sensitivity, gum care.
And the king of that whole segment is still the basic tube of toothpaste, right? It's like half the market.
Yeah, commands between 50% and 56% of the entire oral care market. And geographically, Asia-Pacific is the powerhouse, driving 37% to 43% of global sales. That really highlights how important those emerging markets are for growth.
Okay, so that's the core stable business. Now, let's contrast that with their other major focus, pet nutrition. This one's different. Pure high growth, worth about $126 billion and growing faster, like 5.5% CAGR.
Exactly. And the driver here is very emotional. It's this trend called pet humanization.
Ah, right, where people basically treat their pets like furry children.
Pretty much. And that means they're willing to spend serious money on their health and diet. They're buying premium foods, therapeutic diets, stuff that's science-backed or recommended by vets. And they don't blink at the higher price tag. This is where Colgate's Hill's Science Diet and Hill's Prescription Diet really play. Hill's focuses on that high-end, vet-recommended niche. That gives them a strong channel advantage.
But even though it's growing fast and margins are good, it's not like they have the field to themselves, right?
Yeah.
Hill's is up against some real behemoths.
Oh, absolutely. The pet nutrition world is super concentrated. Hill's is competing head-on with giants like Nestle Purina and Mars Pet Care. Those two combined pull in over $44 billion a year in revenue. Immense scale.
So how does Hill's compete with that?
Their strategy isn't about volume or mass market. It's about leveraging the trust vets have in their specific science-based and prescription diets. They carve out this protected, high-value space where it's more about the science and the vet recommendation than just being on every supermarket shelf.
Okay, got it. So we understand the playing fields. Now let's break down Colgate-Palmolive itself, the company structure and where that famous economic moat comes from.
Structurally, Colgate is pretty straightforward, but yeah, very concentrated. They report in two main segments. The biggest by far is oral, personal, and home care. That's the traditional core, about 78% of their total net sales in 2024.
Okay, and within that 78%, how does it break down?
The real engine is oral care. That's 43% of the entire company's sales, just from toothpaste, toothbrushes, etc.
43%. Wow.
Yeah. The rest of that big segment is split. You've got personal care at 18%, think soft soap, Palmolive, but also those high-end professional skincare brands they bought, like L10MD. And then home care is 17%, with brands like Ajax and Fabuloso.
And the second segment.
That's pet nutrition, the Hill's business we just talked about. That brings in the remaining 22% of total sales.
That concentration, 43% from just oral care, that's definitely something we need to keep revisiting. But let's look at where they sell geographically. That's a big part of their growth story, being so global.
Yeah, they're incredibly spread out. Latin America brings in 23% of sales, North America 20%, Asia Pacific 14%, Europe 14%, Africa, Asia 5%. The big advantage there is the long-term growth runway in emerging markets. The amount of toothpaste or soap used per person is still pretty low in many places, so there's huge potential to grow as incomes rise.
But being that global brings its own set of risks too, doesn't it? Beyond just currency swings, which we'll get to.
It does. One risk people sometimes overlook is customer concentration. Like, Walmart alone accounts for about 11% of Colgate's total net sales.
11% from one customer.
Yep. That gives Walmart significant bargaining power on pricing, shelf space, inventory. It's something management always has to manage carefully.
Okay, let's talk moat, competitive advantage. For a company selling something that feels almost like a commodity, where does that edge come from? It'd have to be intangible, right? The brand.
Absolutely. The core idea is that the name Colgate is basically interchangeable with toothpaste or oral hygiene in tons of countries around the world. They've spent decades building that trust and familiarity. It lets them launch new premium products more successfully and defend their higher prices. And we don't need to guess about their dominance, the numbers show it. As of Q3 2024, Colgate had a massive 41.6% global market share in toothpaste
41.6%.
and 32.3% in manual toothbrushes. That kind of leadership gives them huge leverage with retailers and real confidence when setting prices.
But their rivals, especially the other big guys like P&G, they're not just sitting back, are they?
Yeah.
How are competitors trying to chip away at that dominance?
Well, the competition comes mainly from two angles. First, you have the R&D powerhouse Procter & Gamble with Crest and Oral-B. Their strategy is all about what they call irresistible superiority. They don't just aim to match Colgate, they pour money into R&D to create breakthrough innovations. Think about the high-tech Oral-B IO toothbrushes with AI and connectivity. They try to redefine oral care to justify much higher prices.
So P&G tries to out-innovate them with tech. Who else is a threat?
Then you have smaller, nimbler players like Church & Dwight, the RM and Hammer folks. They use smart acquisitions to grab share quickly. They don't try to outspend Colgate or P&G on R&D. Instead, they buy successful niche brands that are already working, like Waterpik for water flossers or TheraBreath for specialty mouthwash, and then they plug those brands into their efficient distribution system. That kind of targeted disruption can be just as damaging to Colgate's core as a big tech leap.
Which brings us right back to that concentration issue. Having 43% of your business tied up in oral care, that feels like a vulnerability investors really need to watch.
It's the central risk, really. Imagine if P&G did launch some truly game-changing toothbrush or toothpaste that caught on. Or if consumer taste suddenly shifted hard towards, say, all-natural ingredients that Colgate wasn't strong in. The impact on Colgate's overall bottom line would be way more severe and immediate compared to a more diversified company.
Yeah, like P&G you mentioned. Their biggest segment, fabric and home care, is around 36% of sales. Still big, but a hit there wouldn't cripple them quite the same way. A major blow to oral care could hurt Colgate.
Exactly, which is why Colgate's diversification efforts are so crucial strategically. Pushing into high-margin professional skincare, Ultimate D, Filorga, PCA Skin, and pouring investment into growing Hill's Pet Nutrition globally. These aren't just about finding new growth avenues. They're fundamentally about reducing the company's dependence on that one massive toothpaste category. It's risk management.
Okay, let's switch gears and look at the financials, because this is where Colgate's operational strength really comes through. What's the recent revenue story look like?
Revenue's been showing moderate but pretty consistent growth. It hit $20.1 billion in 2024. But the really interesting part is digging into the organic sales growth. Like in Q2 2024, Latin America posted a stunning 18.8% organic growth. That region is just firing on all cylinders, proving that emerging market potential is real.
18.8%, that's huge. And how does that compare to, say, their home base?
Well, North America, for comparison, grew at a much more modest 2.5%. That contrast really highlights how much the company relies on winning new consumers in developing regions, rather than just squeezing more out of mature markets like the U.S.
Okay, now let's hit what I think is maybe the most important financial point lately, getting those margins back up. The inflation hit in 2022-2023 was tough on everyone selling consumer goods.
It was brutal, but Colgate's management seems to have navigated it really effectively through pricing and cost controls. We've seen a strong recovery in their gross margin. That's the profit they make on each item sold before overheads. It expanded quite a bit, hitting 60.6% in Q2 2024, and even better at 61.1% in Q3. Getting back above that 60% mark is really critical. It shows their pricing power held up, and it provides the money they need for their core strategy.
And that money fuels what the company calls its virtuous cycle strategy. Let's walk through that because it's key to how they operate.
Right. Think of it like a flywheel. Step one is operational efficiency, and smart pricing gets that gross margin up over 60%. Then, the extra profit they make doesn't just fall to the bottom line, it gets immediately plowed back into the next step. Reinvestment.
And that reinvestment usually means a lot more advertising, doesn't it?
Exactly. We saw ad spending jump by a huge 16% in both the first and third quarters of 2024. That big push in advertising is deliberate. It's about protecting the brand's health, promoting new premium products, and importantly, driving sales volume.
So the volume growth helps justify the prices.
Precisely. More volume helps defend that premium pricing against the private labels, which keeps the margins high, and then the cycle starts again. Higher margin funds more marketing, which protects the brand, which supports the price.
They're constantly feeding the brand to keep it strong, and they're using tech to be smarter about it too, right? Tell us about this RGM revenue growth management analytics.
Yeah, this is how they try to avoid just slapping discounts on everything, which can hurt the brand's image over time. RGM Analytics, often using AI, helps them fine-tune pricing and promotions very specifically. So instead of a big, blunt 20% off everything sale, they use data to figure out which specific product in which specific store or region is most sensitive to price changes. Then they can offer targeted deals or adjust prices dynamically only where it makes the most sense for profit and volume without damaging the overall premium feel of the brand globally.
Smart. Okay, now let's tackle the financial number that always makes heads spin a bit for new investors. Return on equity, ROE. The reported number is often like over 300%, which sounds impossibly good.
It's an astronomical number, yeah. And it definitely needs a big asterisk next to it. It's technically correct math, but it's fundamentally misleading about the underlying business efficiency. See, ROE is net income divided by shareholders' equity, and Colgate, for years, has had this strategy of returning tons of cash to shareholders through massive share buybacks, often funded partly by taking on debt.
Right, and buying back shares reduces the amount of shareholder equity on the balance sheet. The denominator in that ROE equation gets smaller.
Exactly. When you shrink the denominator, the resulting percentage, the ROE, gets artificially inflated. It's more a result of their capital structure choices and buybacks than just pure operational genius. It definitely confuses people, because 300% of ROE sounds like they make $3 profit for every $1 shareholders invested, which isn't quite the reality of the operations.
So that headline, ROE, isn't the best measure. What should we look at instead to see how efficiently management is actually using all the capital in the business?
The better metric here is return on invested capital, or ROIC. This looks at the profit generated relative to all the capital the company uses, both debt and equity. And Colgate's ROIC is genuinely top tier. It's around 33.9%. Now compare that to a competitor like P&G, which is also very efficient, but their ROIC is more like 20.2%.
Okay, 33.9% ROIC, that's still really impressive.
It is. That 33.9% ROIC is the real aha moment. It confirms that, yes, the company is exceptionally efficient at generating returns on the money invested in its operations. They just generate so much cash. Returning a lot via buybacks makes sense because finding internal projects that can beat a 33.9% return is actually pretty hard.
And that high ROIC, combined with the fact that their business doesn't require huge amounts of new investment, makes Colgate a cash-generating machine. They spun off about $3.55 billion in free cash flow in 2024. That's the fuel for everything else.
And how they use that cash is super disciplined, very predictable. First priority is always reinvesting in organic growth, R&D, marketing, keeping factories up to date. Then, whatever's left over gets returned to shareholders. You see that commitment in their dividend record. It's one of the most reliable out there. 62 straight years of dividend increases. They've been paying dividends consistently since 1895.
Wow, since 1895. And importantly, their business model isn't super capital intensive, right?
Yeah.
They don't need to constantly build massive new factories.
Exactly. Their capital expenditure, the money needed just to maintain things, is relatively low. Recently, it's been somewhere between, say, 14% and 27% of their cash flow from operations. That low reinvestment need is typical of businesses whose main asset is intangible, like their brand, rather than physical plant and equipment.
That's what lets them generate so much consistent free cash flow year after year. Fuels the dividend, fuels the buybacks.
Yep, it's a core part of the model.
Okay, let's pivot back to the major threats and risks. Because even a stable business like this isn't immune to bumps. You mentioned the double-edged sword of being global, and the sharpest edge seems to be foreign exchange FX volatility.
Ugh, yes. This is the big external risk they have the least control over. Because Colgate operates and sells in so many different currencies all over the world, their reported results, which have to be translated back into US dollars for Wall Street, get really impacted by swings in the dollar's value. If the US dollar gets strong, like it has been at times, their fantastic performance overseas can basically evaporate or even look like a decline when it gets reported back in dollars.
Can you give that specific example from the sources? It really drives the point home.
Sure. Look at the third quarter of 2024, specifically their Latin America results. Operationally, fantastic. They achieved 14.2% organic growth, selling way more stuff at better prices.
14.2% growth, great.
Because of currency movements against the strong dollar, they got slammed with a negative 17.4% foreign exchange headwind. So you net those two out. And the reported net sales figure for Latin America was actually down 3.2%.
Incredible. So double-digit real growth on the ground, completely wiped out, actually turned negative on paper just because of currency conversion.
Exactly. The business engine was humming, generating tons more sales, but the accounting report made it look like the business was shrinking in that key region. That kind of FX volatility is just a permanent feature for them. It adds this layer of unpredictability that sometimes makes the market value Colgate a bit lower than maybe the pure operations would suggest.
Okay, let's refine that competition threat we talked about earlier. We mentioned private labels, especially in Europe. But in emerging markets, the challenge looks a bit different, right? It's not just a cheap copycat toothpaste.
That's a really important distinction when we talk about defending their premium price. In many emerging markets, the main threat isn't just a low-cost factory making generic toothpaste. It's often very effective, super low-cost local competitors, sometimes using traditional methods. In many of these places, consumers might not automatically see a branded, Western-style toothpaste as an absolute essential. They might view it more as a luxury item compared to what they're used to.
And these local options can be way cheaper.
Oh yeah, significantly cheaper. Local producers or even traditional things like, say, using a neem stick for oral hygiene in some parts of the world can be priced 30%, 40%, even 50% lower than a tube of Colgate.
So Colgate constantly has to justify that price gap.
Constantly. They have to really push the marketing, focusing on superior cleaning, health benefits, safety, the modern aspects to convince consumers to switch from a traditional cheap method to their branded product and then stick with it. It's a battle to convert habits.
Okay, so facing these big risks, the FX swings, the pricing pressure from private labels and local rivals, the concentration in oral care, how is management actually tackling this? What's the strategy?
Well, the growth plan really centers on what they call science-led core and premium innovation. Their R&D spend isn't huge as a percentage of sales, about 1.8%, but it's very focused. They're trying to make products that are demonstrably better, not just new packaging, but new whitening formulas, advanced therapeutic products for specific issues, even integrating tech like those AO toothbrushes, all aimed at giving consumers a reason to pay the premium price.
And on the acquisition side, they seem very focused on moving beyond just toothpaste and soap.
Definitely. They're using that strong cash flow for disciplined, smart acquisitions to get into related areas that offer higher growth or better margins. We see it in pet nutrition, like buying that Prime 100 fresh pet food company in Australia to bolster their high-end offerings, and maybe more significantly, pushing hard into that professional skincare space with Eltamd, Filorga, PCA Skin. That's a clear strategic move to diversify revenue away from that heavy 43% reliance on oral care.
And it's probably worth mentioning the stability at the top, right? The CEO's been there a long time.
Yeah, Noel Wallace, the CEO, has been with Colgate since 1987. Having that kind of deep, long-term institutional knowledge is really valuable when you're managing a complex global business through decades of change and volatility.
And their pay is tied to performance.
Very much so. Our sources indicate that something like 75% to 90% of executive compensation is incentive-based. It's directly tied to hitting performance targets designed to grow the business profitably and deliver returns for shareholders. So you have stability plus alignment with shareholder interests. That's kind of the management approach to navigating the risks.
Okay, let's start to wrap this deep dive up. For you, the listener, if you're trying to track the health of Colgate over the long haul, what are the key things, maybe the top 3 metrics you should really keep an eye on each quarter?
Okay, number one, I'd say watch the quality of the organic sales growth. Don't just look at the total percentage. Dig into the details. How much is coming from selling more volume versus just raising prices? You ideally want to see healthy volume growth, not just price hikes covering up falling demand. Second, keep a very close eye on that gross margin. Is it staying stable or improving, ideally staying at or above that 60% level? If that margin starts to consistently slip, it's a warning sign that their pricing power might be weakening, and they might not have the fuel for that crucial brand-building advertising.
Makes sense. Margin is the fuel. And the third key metric, Probably tracks the core mode itself.
Exactly. That's market share, specifically in oral care. That 41.6% global toothpaste share is like the company's pulse. Any significant sustained drop in that number would be a major red flag. It would suggest that either a competitor like P&G or maybe private labels are successfully breaking through that wall of brand trust.
Okay, good summary. So to finish off, let's just quickly restate the biggest risks we've talked about for this, well, very stable but sometimes surprisingly volatile company.
Sure. The big ones are that constant exposure to foreign exchange volatility messing with reported numbers, the ongoing battle against private labels and low-cost local competitors trying to undercut their prices and steal share, and that significant portfolio concentration risk being so reliant on the oral care segment. But, and this is important, because they sell essential goods, have a strong balance sheet, and dominant brands, the risk of the whole thing collapsing like a total loss is extremely low. It's more of a slow and steady, gets interrupted by currency headaches kind of risk profile.
Right. Which brings us back perfectly to our final provocative thought for you. It ties together that paradox we started with. We spent all this time talking about Colgate's financial numbers, the $3.5 billion in cash flow, that impressive 33.9% ROIC. But maybe its real strength, its durability, comes from something that doesn't even show up on the balance sheet, that powerful, intangible brand equity.
It's the trust, the habit, built over more than a century. That's arguably driving sales more than any single financial metric.
Yeah, think about it. They sell toothpaste, something essential, sure, but with basically zero cost to switch brands. You can walk into any store, anywhere, and grab Crest or the store brand or some local option, and it costs you almost nothing to switch. No real consequence. Yet billions of people all over the planet keep choosing Colgate. Maybe out of habit, maybe because they trust it, maybe just because the marketing works. So the question is, how much is that invisible brand trust actually worth? Especially when any single shopper could switch tomorrow with zero friction. It feels like a multi-billion-dollar enterprise built almost entirely on collective human habit.
It really is a testament to the sheer power of building a brand through decades of repetition and presence. Something to think about. Well, we'll leave you with that thought. Thanks for joining us for this deep dive.
Until next time.